A lot different conversation if you get into the Eastern Corn Belt, where there's ground piles stacking up.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlon Bowling with you. Always a pleasure to visit with you about all things ag related and ag market related, ag weather related, what have you. Today, I'm pleased to be joined by Joe Camp of Comstock Investments, and we're going to take a look at the midweek markets here. And we had a little bit of turnaround type activity during the session, didn't we, Joe? It was, I guess you could maybe say it was a topsy-turvy day in the markets, and that includes the outside markets too.
That's right. Grains, livestock, the outside financial markets, all interrelated, and even increasingly so lately, leading up to these big events that we know are approaching: the election, the next Fed interest rate decision being on the top of the list for everyone. I think later on in the morning today, we had a general shift that was definitely risk off in the outside markets. Now, normally that can be something that spills over into the ag markets, and often does. But today, that wasn't the case for the grains, and they actually continued higher, probably on some general unwinding of spreads that had been bearish the grains for so long, and ultimately bullish these other markets that are taking a correction lower. And that's starting with the stocks. You've got that in play, the risk off evident in the dollar index, which has been higher throughout the session and continuing to advance as interest rates do as well. All of that occurring since the last Federal Reserve meeting. Also watching the metals, new all-time highs recently for gold, but taking a break there along with silver and platinum. So it is a pause for many markets. And again, just in terms of this week, some follow through higher as we have some shorts unwound on the grains, it would seem.
Now, that's interesting to me. Why would the interest rates on the marketplace be rising after the Fed just lowered their interest rates? Can you explain what's going on with that?
For one, it would seem that there's some tightening of credit in general that would precede the potential fear of a recession continuing to build. Talk about stagflation being an issue, that interest rates have to stay high because inflation is going to remain elevated. At the same time, again, those recession worries about the stagnant part of the economy potentially being a factor here. And you still have the case, it could be true for the dollar as well. You talk about interest rates here in the U.S. and the dollar going higher. We can be the best of the worst in terms of interest rate differentials abroad, and also the strength of the dollar, especially with so much going on abroad, geopolitical risk premium showing up in a flight to quality that's benefited the greenback. Interest rates, continue to rise despite what we had in that lowering of the Fed funds rate. We know they can be separate. The question would be, if we continue in this trend, even with the expectation that next month on the 7th, when the Federal Reserve Bank decides again on interest rates, they're likely going lower, the consensus being a quarter point. Will that shake things up differently? We'll see.
Want more? Sign up today for our premium content. You'll receive our reports twice a day, plus every morning, an in-depth market analysis with Eric Relf. Every afternoon, you'll receive our daily podcast with Marlon Bowling. The first month is only $1.
As we look at the grain sector here on Wednesday, the soybeans actually, probably, I guess you would say, had the best performance. Why do you think that is? They closed in the upper part of their trading range.
I think they had further to catch up relative to corn and soybeans. They had been the worst performer, and so when you do have this launching of some short covering action so far this week, it stands to benefit the soybeans, which were and still are left closer to their recent contract lows than the corn and the soybean futures. Earlier this week, you had the strength to speak of for crude oil, which drove the bean oil higher. Again, much of today's strength in the grains coming in spite of that weaker tone in the outside markets. And ultimately, on a percentage basis, the soybeans just almost keeping up with corn. So corn's still been more impressive lately, has more of a possible trend change forming on the charts now that we're above the sort of middle of the range 20-day moving average, closer to where we were earlier this summer. But a lot of work yet to go if we're going to turn around what is ultimately, of course, still very big primary bear trends in these markets.
Yeah, corn on the December contract, it looks like it poked its head above the 100-day moving average, which is encouraging. And that 62% retracement level after the move from late August, it looks like it kind of held it. It kind of broke it down a little bit, but seems to kind of have held it so far. We've had really good export sales of corn here lately. I don't know if we can keep that up very long. They seem to really be outpacing the soybeans by quite a bit.
That part of it, you start with the technical factor that's driving some speculative ownership, and then the fundamental influence. And the speculators see it as well. I know they're trained on what their computers are telling them, but they're looking for verification from this data on supply and increasingly more and more demand. Because with all that we've had in terms of focus on the harvest, and rightfully so, it's the time of the year where it's more about now, how are we going to use these crops, and exports are that on the margin headline type of influence. And they have been a positive one lately, as you allude to, the flash sales continuing to pop up, a lot of corn to Mexico. We're building a lead now on last year's record pace, a couple of years more than of a severe drought in Mexico leading to those purchases. The wild card, though, is still China, and whether or not that country is going to be in the market for U.S. corn this year. At this point last year, they had purchased some new crop from the U.S. At this point, virtually zero, and likely going to be hedging the risk of a new trade war or increased tariffs by, at least for now, booking with Brazil until we see further clarification.
You know, I keep hearing more and more stories about storage being a problem for corn and soybeans now that we're getting toward the end of harvest here in the U.S.
It's certainly regional. You know, you can look at the West and just monitor basis and the types of overboard values we're seeing trade in the middle, in some cases now just beyond the real peak of harvest and the letting go of grain, which many farmers have. The thought is that a lot of that corn, which is relatively deficit in the West and in the Southwest in particular, it's going to fill the pipeline so fast that we're not going to have big space issues in those places. Now, a lot different conversation if you get into the Eastern Corn Belt, where there's ground piles stacking up. Not unusual, but they're big ground piles, and there's question of when they're going to be picked up this year, and that's riding on the river system, the ethanol demand, everything under the sun. There are going to be likely some storage pressure issues in the Eastern Corn Belt, where there are these big surpluses still carried over in part from last year.
On the wheat trade, if you look back at the last week or week and a half, it looks like we're just kind of chopping around sideways.
Like the international markets yet, which has been the big driver. We had hopes of the Russian market really leading the way higher after the government came in and instituted some price controls. But we know oftentimes the government, any government trying to step in and put a floor on prices sometimes acts the opposite way. And that's been the case where we're up and then mostly back lower for Russian prices. There's a sign, though, that we're generally tighter around the Northern Hemisphere, in particular on wheat stocks. The U.S. has got quite a bit. We're having better exports for the most part at the start of this newest marketing year. So the fundamental picture for now has been pretty positive for wheat. The next thing will be just looking forward into the future and taking stock of all of these growing regions that are becoming increasingly drought-stricken, including, again, parts of the U.S. as well.
Well, I see in Kansas City wheat, where there is a lot of drought talk, it looks like they already have a pretty fair drought premium, perhaps built into the new crop month.
We got to, start with that caveat of how early it is, and wheat able to get through seemingly anything as long as it can, come up, if you will. Oftentimes we're going to make a crop or have that potential, but it is a concerning factor because we know about the ramifications or the outcomes of years past that we've been stuck in persistent drought, including across the Southern Plains. those 3 years in a row of La Nina, which I think we're still more likely than not going to have again this winter.
Well, let's flip the page here and let's take a look at the livestock trade. I see where cattle, they have a lot of red on the screen, led by the feeder cattle on the way down today. And we always have to bring up the old cliche, feeders are the leaders. Well, if that's the case, what hit them today? I know earlier you alluded to the financial markets heading south today.
Yeah,
Do you think that was a big factor in this?
Call it the livestock market, and think about what the stocks are doing here lately. We talked about the grains being somewhat separate from the financial market in an unwinding, but that can fit here with the livestock as well, because the hedge funds, the commodity trading funds, they haven't been net short like the grains. They've been pretty heavily all of a sudden long again in both the cattle and hogs. And so when you have the spook in the stock market, this thought about consumer demand, a lot of the stocks that were down today were consumer discretionary stocks, along with, as we talked about, some of those tech stocks and the interest rate sensitive type of equities that would just overall signal negativity about the economic outlook. And that's what we're seeing in terms of speculators wanting to step out of the market. First, it would seem with the feeders, the long futures play there.
How does that compare to the wholesale beef prices now?
Well, that's why we were just talking about strength earlier this week and the general resiliency. And so that's to circle back and talk about today's move down, really moderate for live cattle futures, but deeper, as mentioned, for the feeders, a couple of dollars in some contracts, including the January, where the choice beef action, the prices in the cash trade would not suggest we've got material weakness that just has to kick off from here. Instead, cash prices steady and thought likely to advance potentially by the end of the week in places. And that box beef average, to start the question, just holding up so strong at a time of the year when we would be normally thinking about the wrap up of summer, the early push for the fall and winter holidays, but then seasonal weakness around, and you don't necessarily have it. Now, that could change if the stock market continues to fall and sours confidence for buyers, but it's a positive story. Today's a correction, and again, a financial market link.
So who would have thought a month ago that you look at a chart right now and lean hogs would have the best looking chart out there?
No, and the huge discounts to the back months made us think about getting some of these premiums cleared out, and then being in store for weakness to come throughout the winter, and these projections for supplies still to swell through maybe the first several weeks of even 2025. But beyond that, you can paint a much healthier view all of a sudden of the hog market because of still consumer demand holding up, still domestic consumers being supported by record strong export demand for U.S. pork, and then the future outlook for the supplies to start to tighten again as soon as early spring next year because of what were recently the lower prices and the move away from production. So it's a market that's corrected itself, I think, fundamentally with basis, with support for seeing what we're seing.
Anything grabbing your attention these days in the outside markets, like the soft markets or maybe the metal markets or anything?
Well, soft markets continue to trade with heightened volatility. We're talking about orange juice prices pushing up because of the recent double whammy hurricanes across Florida. There's still big movements for coffee, cocoa, because of extreme weather abroad. Those moves in the soft commodities can be a precursor or a foreshadowing of what can occur in the grains, just because of the continuation of these extreme weather events. And it doesn't just have to be here in the U.S., but again, around the world, if we're talking about some of these things grown elsewhere. So that makes me think again about what we brought up just briefly, the possibility of a coming La Nina, still hurricane season not being over for us, and the drought we talked about expanding. Doesn't seem like there's, besides we talked about the Kansas City wheat market, I know it's the time of the year where we're thinking about this crop just being harvested and put away, but the long-term risk of severe weather and a return towards drought and a La Nina weather market in South America as well, for example, makes me think we're not necessarily done on having a bullish weather market. And so I want to keep that in mind.
And of course, I don't need to really mention the fact that we're getting ever closer to Election Day. So who knows? That could be a wild card for anything that happens after that. So just have to keep that in mind. Joe, always good to visit with you. Thank you, sir, for spelling things out today. And again, I want to remind everybody, if they want to provide comments about how their crops are turning out in their neighborhood, enter them in the comments down below, and we'd be glad to host that and see how everybody compares with everybody else in their growing season this year. Appreciate that very much. That'll do it for this episode. And for Brianne Hendrickson, our producer, I'm Marlon Bowling. We'll catch you next time right here on the Comstock Channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.